rent and your auto. What else would be in
Food,
that? Food would be
cell
in that bucket.
phone, internet, electricity,
All
your
inside of
basic,
50.
all your basic essentials.
So
That's
don't
correct.
don't spend 49 and then try to eat on 1%. You
Right.
might not make it. All right, so
Right.
let's keep going. So
Right.
50%
Right.
goes to essentials.
Yep.
What's the other percentages?
15% in combination with your company match should be saved into your 401k. Pay yourself first, ladies and gentlemen. I like to share with folks over the last 13 years, pay yourself 15 cents on every dollar. Then on top of that, put that company match. Then we go to that 5%. That 5% goes every month into an emergency bucket, right? Try to build that one brick at a time. That still leaves 30% of every dollar for your discretionary spending. And then we touched on this earlier. Do we realize that Nielsen has done some great research on this whole black buying power myth? $1.6 trillion with a T was spent in 2020 discretionarily. So when we talk about these retirement gaps, and we talk about the inheritance gap, and then we talk about financial wellness, ladies and gentlemen, there's a huge disconnect, because if we're discretionarily spending 1.6
the
trillion,
money was there.
Okay, we've got the capital. It's the allocation of the capital, in particular the mindset of spending and consuming versus saving and building. And so a big part of what I like to talk about is how do we shift that mindset? And we talked about earlier, but I'll be even more definitive. Have you written down your goals? Even before I get to my trainer or my advisor, what is my intention? What am I looking to accomplish? Am I going to retire at 65? Is it going to be 67? And when I get to that point, do I need 1 million? Do I need 2? Do I need 5? And then what do I want my lifestyle to look like? Again, first layer, right? Because it's automation, it comes out every 2 weeks. Then we got to talk about the market. I mean, there's so much that goes into it. So financial planning is a critical piece that we miss. And then the other piece that I have to end this with is going through COVID, we realized a couple of things. That the shortage of that emergency savings had created a huge disruption in the underserved population. I like to say it should be really 6 to 8 months, because if you lose your job, it might take you a year to get that next one. So the old school philosophy of 3 to 6 months might have been relevant 20, 25 years ago. But in today's world, I really like to ratchet that up to about 6 to 8. And then if you have your own business, it should be around a 12-month cycle. So if those revenues do stop, guess what? I don't have to close my doors. I have sustaining power, and I don't have to take a loan off that 401k.
So let me tell you guys a story for a minute. So my dad worked at UPS for 32 years, and my dad grew up on a farm. My dad grew up in rural North Carolina, very low-income environment, and he started to obtain his goals from ear hustling at the water cooler. He would hear his white colleagues say, well, I want to be able to save enough money and invest enough money where I can live on just the dividends that come in and without touching the principal. So that became a goal for him. At the water cooler, they started to say, I want to retire at 50 and be able to buy my next house for cash. That became a goal for him. These are things he never would have thought about. I'm just giving you those two to start. But give me examples of some audacious goals that we need to be thinking about, that we need to talk about, so that we can shoot for these types of things. And we'll start with you, Jason.
If you have kids, you should, or children, I should say kids, you should have 529 plans in place, or you should be trying to put those in place to help alleviate the burden. You probably won't solve for the full expense, it's possible, but and we talked about this earlier, like tuition, right, financial aid, like you got to pay that stuff back, and it's expensive. And how many, we all want our children to go to school to become doctors and lawyers, but some are creative, and that's okay. And if they're creative, then they probably have a starting point from an income level that's a lot less, but that money's due X amount of days, months, years after they graduate. So you're gonna still have to help them pay that finance debt. So being able to help plan for their future without compromising your retirement is something that requires a conversation and a strategy. That's number one. I think people should do a better job of planning for their trips, the big trips, the extravagant trips. Because those expenses, if you finance it on your credit card, and again, debt just went up over the last 24 months. You know, you're watching, or the last 12 months, you're watching the cost of capital to borrow is going to continue to increase. So if you're financing that on a credit card, you're paying for that trip twice. So again, being able to say, hey, this is where we're going to go as a family in a year or so, and we're going to start putting money aside to do that. One, it helps your children understand that, oh, it doesn't happen automatically. We just don't go. Nope. We got a plan. We got to all pull in the
DoorDash
same
doesn't
direction.
just show up and bring us the food?
Exactly. So, I don't know about how audacious those are, but those are the ones that slip through the cracks and end up mounting and costing you so much in the future, and you're still paying from a trip from the past.
Yeah. I'll give you another audacious goal, and I want to hear from you, Shaun. I would like to have my money working for me so much that my investments bring me more income than I earn in my day job. And that's a realistic goal that I'm sure for you, a lot of your clients have achieved that. But let me hear about you, Shaun. Just some dreams that we want to put into the minds of our audience today, audacious goals.
That's a funny one for me because everybody in this room is different. Everybody has a different belief system. So what might motivate you, might motivate me, might not motivate somebody out here. So really for me, there's no goal that's too big for you to accomplish. But you just have to sit down and ask yourself, what is it that I want to accomplish? There has to be an intention there. Once we have that intention, we set that GPS unit. Even when the storm comes, I'm going to end up where I'm looking to go because I'm intentional about it. The one thing that I have found, Allan, about dealing with affluent clients is they are extremely intentional about their money. There's no misalignment of what they're looking to accomplish, and their money is working for them when they're sleeping. So that could be with real estate, it could be owning a business, but again, it starts with understanding your capital and your income, and then we start to create these buckets that we're talking about on how to get there. And that's extremely important. And then the other piece on the legacy part, which is that protection part for generational wealth, we do not leverage life insurance, ladies and gentlemen, in the proper manner. I spent about 5 years with a life firm, and we had a $50 billion initiative. Eugene Mitchell, we talked about that, right? To put money back into the black community from a contractual perspective, so that when we pass, I'm spending all my money. But when I pass, I'm passing on 2, 3, 4 million. And then there's a strategy called child gifting, where we have a $16,000 gifting exemption that we can pass tax-free, put that into that permanent policy, and hopefully 80 years from now, that policy is going to be worth exponentially more than I funded it with. That's the other thing that I found that we're missing as far as how to utilize the tools to truly create generational wealth and not necessarily always have it based on a speculative proposition, but a contractual proposition.
I want to put a bow on that because, again, you talk about audacious goals and he's talking about wealth transfer. The part that often happens in our community is grandpa passes, money goes to grandma. Children waiting for grandma. When grandma passes, money goes where? State. That's right. It goes to probate. So if you haven't sat down, and most of us, if you work in corporate America, you have access through your benefits, and this is benefit season. If you haven't sat down to talk about creating a will or getting just a basic trust in place, then you're going to lose some of those returns, right? Because you're going to lose it in time because you're going to be fighting the state to get your money back through the probate process. Or you're going to also, if you don't have your account set up right, even when you pass it on, it's going to create probably an additional potential loss because it wasn't structured to pass through the proper way. And like I said, in most cases, those are accessible to you at a very low cost. But if you have to pay, it's still cheaper to pay for that now than for the negative impact of having your family later.
So let's do it again.
Allan, let me piggyback on that 1 second. Let me give you all an example of what my brother just talked about, because I've been preaching this to everybody. I love me some Prince.
I love Prince.
Yeah.
I love me some Prince. He didn't have a will.
Aretha Franklin didn't either.
He didn't have an estate plan.
Yeah.
He had an $800 million estate. The government took 40% off the top after that 11 point something exemption. The state of Minnesota took their 17%. That was 57% of his estate gone because he didn't have his paperwork in place. Yeah. Then you got the court costs and everything else, and by the time they figure out what blood relative is who, right, there's pennies.
Do you think he wanted his masters with his masters? That's JC.
Right? No, he probably didn't, right? But then we look at my brother Kobe Bryant. rest in peace. You ain't heard a word, have you? You know why? Because my man had his paperwork in place. And Vanessa and them girls are straight. So our zeros might be different, ladies and gentlemen, but our families are just as important.
Well, there was one publication. So Vanessa Bryan had filed with the probate court to add their newest daughter into his estate. So
Okay.
the only news doesn't come out of it, right? Because she wasn't in the.
Makes sense.
The newest one, right? Okay. And he may not have gotten to that at that point, right? Yeah. But that's minimal compared to what could have happened.
Absolutely.
All right, so let's do it again. Close your eyes. You can trust us. All right? Who's got a will and an estate plan done? Raise your hand. Okay. Wow, this is a good group. You can close your eyes. Open your eyes again. Probably about 40% of the room.
Yep.
And that's probably about the national average. But we need to flip that on its head. We need to make sure that we increase that percentage. We've got most folks maxing out on the 401k. We've got to get most folks doing an estate plan as well. So let's keep going. Right now, the title of this thing was in a post-COVID world, right? And post-COVID, so during COVID, we saw a massive drop in the stock market. We're seeing it again. We're seeing it for new reasons. We're seeing it because of inflation. There's somebody out here that's terrified. There's somebody out there that's probably like, you know what? I want to just go to cash right now. Let's just talk investment 101. How do you take advantage of, or how do you consider moving in an environment like now, which seems very uncertain? Whoever wants to start.
Yeah, I'll start and pass it back to you. I'm sure we feel the same about this, so please jump in at any point. You know, it's interesting times. But let's go back to March of 2020, where as things were shutting down, you saw the market just drop. It just declined 20%, right? Now, I won't poll you, but I assume many people in the room probably felt like, man, it's probably a good time to get out because who knows when the bottom is going to drop. I see heads nodding the other way, but I see plenty that are nodding at all. So for those whose heads aren't nodding at all, it's Trump. It's a natural emotional affect to feel like I need to get out. I don't want to be the last one holding the bag. Looking back, I think most of us agree that, man, that was the time if you had extra cash to buy, right? And then going forward, typically, in most all cases, when because economies rotate, right? They're cyclical, right? And the market is too. So when you have these down cycles, if you look back in time, probably was the best time to buy, right? And it may not mean for you to buy individual stocks because you may need to buy it through a fund because you can get more bang for your buck and get more impact for your dollar. But the idea that if you right now are going to sell, probably bad idea, right? If you miss out, like I forget the number, like top 10 days over a 2-year period in the market, right?
Cut your returns 50%.
Yeah, exactly. On top of that, you'll never know when to get back in. So I have a client who's wealthy, automotive dealer, done very well. He got out of the market, I'd say almost 12 years ago, and he's super smart. But he can never find an entry point back in because he always feels if I get in now, if it sells off, then I'm going to be down again. I've shown him the 482% return since the day he left the market. Doesn't matter, right? So I always tell people, stay invested. I don't care what your background is, stay invested. Don't sell out your 401k. You have money coming in every 2 weeks. You're just buying shares cheaper at a lower price every 2 weeks. And then at the same time, right now, if you have cash on hand, I don't know, 10 years from now, do you think the market will be higher or lower? If you have a 10-year horizon, probably should buy as much as you can now if you have access to liquidity. That's why you want to have a liquidity bucket to take advantage of market pullbacks. We had an interesting run in the market for so many years where we didn't even have the average of twice a year 10%, once a year 20% pullback and it snaps back. We didn't have that until now. So people psychologically aren't used to that because for quite a few years the market looked like it was just going straight up. Yeah. But that's caught up to us now for a litany of reasons that we don't have to get into now. But it doesn't mean that things won't self-correct back the right way. And you're gonna, if the S&P goes to back to 6,000, then goes to 8. If you didn't get involved now with it, you're gonna pay way more for stuff that you would have bought now. And you don't want to do that.
Yeah, Shaun.
I want to attack this from a historical perspective. We've seen this before, right? The markets do cycle. I want you to look up this term if you don't already know what it is, dollar cost averaging. It is a systematic approach, whether you're in your 401k or you're just doing it on your own, where you're taking increments of capital at systematic points and you're buying shares. So whether that market is expanding, whether that market is contracting and pulling back, when it's pulling back and contracting right now, we have a 30% sale, right? It's like me going and buying a suit. Last week the suit was, full MSRP. This week they got a red tag sale on it. Same quality suit, right? We're buying good companies, not junk, and we're owning those companies. We're not playing the stock market. The other thing that I would share is when we go back historically, we can go back to 2008, then we can go back to 2000 even when the dot-com bubble. We can go all the way back to 1929. The one thing that I will share, and I want everybody to please Google this, go back and Google, the stock market going all the way back to 1929 till today. You're going to find one thing that's consistent: disruption. There's always disruption happening in the world. There's always something or somebody
Plagues,
not cooperating. This time, when we had a 12-year bull run, right, from '08, because what did the Fed do? They quantitative easing. Well, guess what? We got spoiled for the last 12 years. So if we look at the chart, the interest rates were extremely low, lower than they've ever been in history. At the same time, you could throw a dart and make money the last 12 years. Well, 2013, 2015, as the economy started to recover, what should have happened was the tightening started to lever back up so that we're not sitting in this situation. But because we're scared of having that conversation, because we don't want to shake things up, we got to pay the piper a little bit late. If you have that 13 or more year time horizon, 85% of your position should be looking for growth. 60% into the domestic, 15% into international, and then we have the other percentage into your fixed income. That's the asset allocation that we talk about. How's the cake being mixed up? The closer you get to retirement, we have to shift that. So asset allocation is in fact critical in the premise of building wealth, building your retirement, and building generational wealth. And this is where that financial literacy is so important. When we think of mutual funds, okay, what's a mutual fund? It's a basket of fractional shares of independent companies.
Yeah.
Right?
On that note, let's do some investor one-on-one real quick. Okay. It's funny, I got an MBA in finance, and I learned for the first time what a stock is, what a bond is. I'm going to just go lightning around real quick. Let's start with you, Jason. What is a stock? And then I'll go to you with what is a bond.
So a stock, assume it's publicly traded, not private stock, but public stock, it's the actual shares of a company based on their overall value, and they put those shares back out to the public, to institutions to buy, and then based on what that company does on a revenue basis, quarterly they report, and then idealistically, if people see value in it, they buy more and it raises the overall value of the company.
So you have a percentage ownership in a company.
Right.
If they make money, then you make money, you hope.
You hope.
All right, what's a bond?
Bond is simply debt. So if you issue a bond, I give you, let's say, $10,000, you give me a coupon back for being able to borrow that money.
It's a loan. You give a loan to the U.S. government or a loan to a company.
And you have a couple different types. You got municipals, you got corporates.
Okay. Right. When you're young, you should own more what? Stocks.
Equities, yeah.
Equities. When you're older, closer to retirement, you should own more what?
It should be a 60-40 split.
But you should own more. You should be moving more towards which direction? Which seat? The stock seat or the bond seat?
So the fundamental would be fixed income, but we still have to factor inflation even in retirement.
Understood. I'm not saying all, but more. Yeah, I think
you see an increase in fixed income,
right.
Also in dividend-paying stocks. Dividend-paying stocks now over the next couple of years will probably actually outpace treasuries. So you're going to get a greater dividend for some of the blue chip stocks that you maybe would have stayed away because you were buying more growth stocks.
And what's a dividend, sir?
The dividend is what the company actually will also pay you quarterly for owning their stock.
Mm-hmm. And
that's income.
And what do bonds pay you?
Your coupon rate, your yield.
Interest?
Interest, yep.
Mm-hmm. These are basics that I want to make sure folks understand because I don't want anyone to just glaze over this and not understand that. And a stock, a mutual fund, is that if I said I'm in all mutual funds, does that mean I'm risky or I'm safe? If I say I'm in all mutual funds?
Doesn't mean either, actually.
Yeah.
Yeah, mutual fund is just a basket of investments. It's really important to understand what's inside. You guys agree with that? All right, cool. Questions from the audience. I've got a microphone up here. I'm going to ask you guys. There's actually one in the middle. If you could just come up, state your name, favorite artist, and now come on down. We got some questions. We got some experts up here.
And while he's coming up, I want to bring up, when you go into your 401k, there's an absolute difference between the pre-tax and the Roth. That's part of that basic fundamentals.
Let's talk about that after these questions for sure. Sir.
Good afternoon, gentlemen.
Good afternoon.
My name is Romeo Hubert, and I work for Travelers Insurance. The question I have is with respect to crypto, and what is your position on that being part of your portfolio as it pertains to retirement?
Great question. Crypto.
So, we average anywhere between 3%, maybe 5% of crypto, something speculative.
I don't even have an opinion on it. I don't mean that negatively. I don't invest in crypto. A lot of my clients do. But it's not part of our overall portfolio at JP Morgan.
Yeah.
All right, thank you.
I'll tell you my answer. So we heard 3 to 5%. We heard 0%. I think everyone should understand crypto. I think everyone should understand the blockchain and the ways in which the blockchain can be applied in the future. There are a lot of companies that are going to leverage the blockchain in disrupting certain industries. And I think it's good that we understand these things. I invest in crypto, but in a real small way. Like, it's not going to change my life, but if it turns out to be, lights out, then I'm taking a little ride. But I'm not going to put all my money or even a big piece of my money in crypto.
And you can actually go to Fidelity's website, and we actually do have a section on crypto. Very educational, very easy read, very easy resource.
Great.
Thank you.
Good question. These questions are about to get better and better, I can tell.
All right. My name is Denzel Richburg, Cognizant Consulting President. Question for both of you gentlemen. What do you think about I-bonds and also just a return rate, which is approximately maybe about 8 to 9% at times? Why isn't it vastly, I would say, out there for us? Maybe, I think only maybe 1 to 10% of the top 10% probably buy I-bonds, but it's very profitable. It could be, potentially. And also, what's your take on the contrarian investing in the sense of maybe the Rothschilds, or either, I would say, Warren Buffett's type of mentality related to contrarian investing?
All right, so we got I-bonds and we got contrarian investing.
I don't particularly have an opinion on the I-bonds.
I can talk about I-bonds if you want me to.
Yep.
If you want. All right, so I'm a fan of I-bonds. They are not easy to buy in the sense that you can't buy them in your brokerage from your typical brokerage firm, whether it be Fidelity or Schwab or wherever. But they are easy to buy because you just go to treasurydirect.gov and you can buy them. What's good about I-bonds right now is that they're basically giving you a coupon that is based on inflation. Inflation is high right now, and that will be locked in for like the next 6 months, the interest rate that you get. And so right now, it's a great time to be looking at I-bonds. The only downside to I-bonds is that you can only put in 10K, and a lot of y'all have a lot of money, and so you might feel like that's not enough. It might not make that big of a difference, but that's one. The second disadvantage to I-bonds is just that if you decide you want your money out sooner than the term, then you lose some of that interest. But I-bonds, I think, are a good thing to look at for a lot of folks. The reason why you probably don't hear about it a lot is because the brokerage firms don't make money on it. Like, the brokerage firms can't sell it. You have to buy directly from the government, so who wants to advertise that? So contrarian investing, the idea of buying when there's blood in the street.
I love it because fortunes have been made during a time of disruption. And I love Warren Buffett. He buys good, fundamentally sound companies.
He bought the Bank of America warrants
and he holds them, for the long term.
Yeah.
I'd agree. It's the best time to invest. You talk about Warren Buffett, who bought the Bank of America warrants that he flipped to common share equity at the height of the global financial crisis. And people are like, what are you doing? And it worked. Right?
Perspective, right? Like, these people have a long-term perspective. So if we pay attention to this 24-hour news cycle, it's going to drive us crazy. So we have to have a longer-term perspective, and we navigate through those markets, and we take advantage of all the different pullbacks.
Yeah.
Thanks, gentlemen. Appreciate it.
Great. I will say, if you're going to be a contrarian, you got to have a strong belief in whatever you're doing, because it's going to look ugly for a while. That's for sure. All right, sir.
Hi, my name is Donovan Morgan. Thank you, guys. I'm an accounting manager for ABM. My question for the panel is now a good time to purchase a home? If not now, when? When do we think the interest rates are going to go down?
All right.
So it's more expensive to purchase a home. It's actually gone up a lot, because just a year ago you could get a mortgage for at 2.753%. It's double that, right? But again, when you're purchasing a home, we go back to this conversation. What's the plan? Is this the first home? Is it the second home? Is it is it for 30 years you plan to be here. I mean, eventually rates will come down. You can always refinance potentially. I just think the conversation is greater than just, is it a good time? I'll give you an example of that. When we look at, just home sales in Michigan, because there's just there's a scarcity of new homes that were built. I mean, people are actually still paying top dollar premiums, even with mortgages being around 5.5%, 6%, right? Because the demand is still there because people still have money in their pocket, which is part of the inflation problem we're having, is that people literally are still buying homes with a 6% mortgage, right? Which that's a bigger issue for us over the next probably 12 months about how do we cool this economy down if people are willing to pay that much for a house. But again, if that's where your family is right now, equity in a home does beat having an apartment. So you just have to figure out, back to your 50% rule, with that amount of interest that you're paying to the mortgage company, can you afford that? And then can you ride it out till you can refinance and maybe do the same, have the same house at a cheaper price point because you refinanced?
Yeah, I'm a big believer in home equity as one of the biggest keys to wealth creation. If you look at the American balance sheet, home equity is probably the second biggest or the biggest thing on there for a lot of families that have wealth. 401k, retirement dollars would be another one. The thing about, to Jason's point, when you're paying rent, you're at risk that rent's going to keep rising because of inflation. Like, that's the beauty of owning an apartment building, is you can raise the rent every year. But that means it's the opposite for you. That means every year your cost of living is going up because of inflation. The beauty of a mortgage is that even if the house doesn't appreciate, two things are definitely going to happen. Number one, you're going to pay off the mortgage eventually, right? That means that all that asset is owned by you free and clear. The second thing is, if you've got a fixed rate mortgage, you've just locked in a fixed payment for the next 30 years. While everybody else's rent's going up, yours just stayed the same. And then the cherry on top is if it happens to appreciate, which again, even if it doesn't, there's still a lot of good things with home ownership. So next question, sir. Thank you for the question, by the way. Next question.
Jerron Tyler, residential mortgage loan officer with New American Funding. Question
Talk to that brother in the back, too.
Yeah, he got me excited. He got me excited. But I wanted to ask you all, and I guess anyone can answer, what would be the one thing in retrospect that you wish you would have done or wish you could have done in the beginning of your journey that you believe could have changed the financial trajectory of you and your family?
Good question.
Wow.
I told you they're getting better and better with these questions.
Yeah, I'll take that one. I would have started much earlier, and I was literally having this conversation at lunch today. I would have started trying to max out that 401k earlier in my career and allow that compounding interest to work in my favor. And I know the Roth 401k part came in 2006, but I would have taken advantage of the Roth benefits to set myself up for tax-free income. And then going back to that last question, I want to take that interest rate question, and yes, the interest rates have in fact increased 2 times, right? But let's, again, going back to my perspective, historically, anybody remember buying a house back in the 80s? It's 15%.
Not in this room.
Right? Our parents, right? It's 15%. So the truth is, historically, we are still in a historical low interest rate environment. To me, if I go back to 40 acres in a mule, that was 400,000 acres that were denied us. Home ownership.
And by the way, did you know that we would own all the land between Charleston and Jacksonville?
that whole corridor. Yes, sir. That's powerful.
Yeah.
So if I'm buying a house, I would have loved to get it 2-3%. That's beautiful. But if I look at the historical perspective, which is where I really want to try to get my clients, is I got to get them out of the today's space. And let's really broaden our horizons to really look at historically where we are. We're still in a low interest rate environment. So if a person can own that, man, please go own that.
Your question. Did we get to your question?
Yes, he said started earlier.
Yeah, start earlier. Absolutely.
Yeah.
Yep.
I agree with him.
Yep. And that Roth is just
I'll give you
a
one
beautiful
more.
space.
I did this, and I think I wish more people would be open to it. I left corporate America at 33 years old and started a business. And I didn't start a side business. I started a business that would take care of me and my 3 kids and my wife. And it worked out really well. And it was during a time like this. Like, it was in 2012. We were still potentially, folks felt like we were in a recession. That was very contrarian of me. I just wish more folks would be entrepreneurial. it's not for everybody, but someone like you who's in mortgage business, like that's a business where you see folks start businesses. You know, you can get a license, you know, you can get connected with lending sources, and you're in that type of field. So I would just say for folks who are young, who have drive, is just consider full-time entrepreneurship as an option.
Thank you. Great
All right.
question.
Sir.
Thank you for being here today. My name is Jim Thornton. I'm a financial analyst with the FDIC. You mentioned earlier about estate planning, and what are your thoughts on a revocable trust versus an irrevocable trust?
Good question. Revocable versus
depends.
irrevocable.
I would say revocable gives you the flexibility while you're alive to constantly make changes. And I actually thank you for mentioning that, because the point I didn't make is once you set the trust up, you cannot put it on the shelf. Right. You have to review it. And a revocable trust allows you to make changes, where an irrev trust, for the most part, once you have it in place, it's hard to make changes to it. So I think at our age and stage, as I look across this room, a revocable trust possibly makes more sense. But again, talk to a professional. I'm not an attorney, but high probability a revocable trust is right now is more beneficial than an IRREF.
Yeah, it depends on what you're looking to do. The benefits of a revocable trust would be, number one, it's a fast probate process, or really you're skipping the probate process. That's number one. Number two, it's getting the assets exactly where you want them to go with some strings attached. Like, for example, one of our clients had a trust, a revocable trust that turned into an irrevocable trust for his kid. And the trust basically said, kid, if you want some money from this trust, you got to work. If you're not working, you get nothing. Right. And if you work, we'll give you $3 for every dollar you earn. And if you're not working, then you get Nathan's, right? You get nothing. So the concept of a trust is powerful. And for those we have a podcast episode called Trust Fund Babies on Momentum Advisors. If you do a search for Momentum Advisors podcast, we break down trust and the difference between irrevocable and revocable as just a chance to go in a little deeper. But great question.
Thank you.
All right, we got one more question, and then we'll be wrapping up soon, boys and girls.
Just want to thank you, gentlemen, for all the knowledge and gems you've dropped on us today. I'm Joshua Weaver, an associate analyst at Ally Financial. And my question is, as a young professional, besides investing in and maxing out your 401k and having a life insurance policy, how else can I best set myself up financially in the future?
Great question.
I mean, you can always get just a non-retirement account, just a regular brokerage account, and start to fund that, and then work with an advisor to figure out what your asset allocation was comfortable based on your risk tolerance. If you love having your own business, maybe you look to start your own business, because we find systematically that people that own their own business, that's an asset that continues to grow, and you own that. And so if you build that business up, and then all of a sudden, guess what? You sell that business, there's an infusion of capital. So there's so many different ways other than that 401k. But again, it goes back to what's your intention, what are we looking to accomplish, and then out of our budget, how do we fund it? And then we start to funnel buckets of money into different accounts to start to build and save. So it's a very systematic approach that I've seen over my 13-year career that have taken people from point A to point B in a logical, fundamentally sound way.
Yeah, because I know we're wrapping up. I want to just double down on that. It has to be a goals-based process. I hate when people talk about I dabble in the stock market or I play the stock. Like, if that's what you're doing, stop. Just stop.
Yeah, we're not playing.
Right? So you need to have a fundamental plan in place that makes sense so you can begin to create wealth. And if capital markets are a part of that, then fine. But you should not be playing with your wealth. It should be a serious process that involves everything we talked about today. Because that's the only way it's actually going to work, and you'll take it seriously when you have these down cycles that we're having right now. It's because you had a plan in place that you can go back to and review in the first place.
I'll add in something that these brothers did not hit on yet, but I would tell you to try to figure out ways to make more money in a field that you're passionate about. For me, I quit corporate America twice. The first time was to go back and get an MBA full-time. I went full-time. People thought I was crazy, but I came out and I made triple the income that I made before I went in. And I got a full fellowship. And for most black folks, men and women, if you go to a top business school, full-time, you'll get a fellowship. for at least a portion, if not all. So I would definitely try to tell you, think about ways to make more money in a field that you're passionate about. Because I'll tell you, a lot of folks are not working in a field they're passionate about. But if you could find that intersection of like, I'm good at it, I'm passionate about it, and I can make money from it, that's wealth in a sense. Like that is something that's going to enrich your life and it's going to help you to be more successful and build more wealth at a faster pace as well. So thank you for the question, brother.
Thank you. Thank you.
All right, so we are in the home stretch. It is 4:05. We're supposed to end at 4, but time flies when you're having fun. Let's go to your last comments, and also if there are ways for folks to find you, whether it be social media or any other aspect, let's go ahead and get that out there as well.
I cannot top that closing I just did, but I'll try.
If anybody could do it, it's you.
So you can hit me on LinkedIn. I don't carry business cards anymore for some reason. It's a COVID thing, I guess. It's just Jason E. Tinsley. That's the best way to catch me. And what I'll leave you with is just to, one, thank you for coming to our session. That's important to us. This means they just
yes, thank you.
So thank you all for coming to our session. And thank you for having a listening ear. My ask is that when you leave up out of here after the conference, go sit down and start to put that plan together. Or then we did waste our time, right? So take that next step if you haven't already, and if you have, then please go review and revert back to the plan you had in place and see if it still makes sense for you. That's what this is about. That's how you create generational wealth. Do like I did, start having conversations with your children. As uncomfortable as it could be, but you gotta have it if they're minors, so you can begin to plant that seed. Because most of us, as I said earlier, are setting our children up optically to see a lifestyle that we probably didn't have. And they're taking it for granted because it's all they know, and it's not their fault. So have those kitchen conversations that you mentioned. Have those conversations and have them often.
Great.
Thank you.
Shaun.
Because I'm in the 401k space, that's really, like I'm a coach at heart. Like that's my passion, is trying to coach folks up. I would leave you with a couple of things. One, we do have to put in the work. There's just no easier, softer way, ladies and gentlemen. We have to put in the time and ask ourselves certain questions of what is it that I'm looking to accomplish. So my homework for you this weekend is to grab you a cup of coffee, break out a piece of paper, and start putting that budget together. And in particular, look at your discretionary spending so that you can figure out what your behavioral pattern, like me and Walgreens, I got a great relationship, right? Peppermint patties and Haagen-Dazs ice cream. Like I can go in for one thing and come out with $20 worth of stuff. And so when I did that exercise, it changed my life. The second thing is, again, what is your intention? What are we looking to accomplish so that you can set your parameter and your GPS where you want to go, and then you can start to build accordingly. Then the third thing I want to leave you with is this. If you are in this room and you have a Fidelity 401k, you have the resource of a 1-to-1, doesn't cost you a dime. Call the investment center, call one of my workplace financial consultants, but get some one-on-one time and leverage that resource. If you have a other 401k plan, call to see, do they offer one-on-ones, and have a 1-to-1 session so that you can get some individualized attention and figure out how to get through this particular market. And then the final thing is understanding between the Roth and that 401k pre-tax. What are those rules so that you understand when I'm pulling income out after I'm 59 and a half, how much of that do I want to be tax-free, i.e. your Roth 401k, and how much do I want taxable, knowing that at 72 they're going to make me take a required minimum distribution. So it's the income and how that income is taxed that's a critical piece to the landscape to creating that wealth.
Great.
And you can connect with me on LinkedIn all day long.
And you tell me if I'm wrong, but right now, if you have a traditional IRA, it's probably down. This would be the time to take the tax hit.
And make that Roth conversion. That's correct. Yeah. But on the 401k side, here's where folks get confused. You got the Roth IRA, that's only a $6,000 contribution. And if you make too much money, you can't contribute. You get phased out. In the 401k, if you chose, you could put the full $20,500 in that Roth 401k, and it's not going to phase you out because of your income.
And it grows
So
tax-free.
again, understanding the rules of engagement is the most powerful piece that I can give my clients.
Amen.
All right, I'm gonna give my 3 things and then we're gonna close out. Number 1, forget these statistics, the negative statistics. They got nothing to do with you. They really don't. Just because they say it's gonna come true for somebody doesn't mean it's gonna come true for you. That's number 1. Number 2, have some goals and some dreams that are audacious. Because I believe, like I believe in the Bible, and the Bible says I can do all things through Christ. It doesn't say I can do some of the things. It didn't say I can do a little bit of things. It said I can do all things. And I believe that, and I believe that for y'all. And the last thing is, check out my podcast. It's all about this conversation, keeping this conversation going. It's about wealth building. It's about financial literacy in the Black community. It's Momentum Advisors Podcast. And our website is momentum-advisors.com. Thank you for your time, everybody. Thank you very much. Thank you, Black Enterprise. Thank you, Alfred Edmonds Jr., wherever you are. Thank you,
And by the way, anybody, Fidelity is having a VIP reception. We're having a VIP reception right now, actually. It's in the Chesapeake room. Got a couple refreshments. I'll be dropping.